Hi, this is Professor Alinda Kiss, and I'd like to talk about liquidity risk in conjunction with the L of CAMELS. So let me share my screen. The regulators use CAMELS to look at how well a bank is being run. They look at 5 areas: capital adequacy, asset quality, the credit risk, management, earnings, liquidity, and sensitivity to market risk. So they have designed a training, this is from 20 years ago, for directors of small community banks to talk about what they should be looking for when they are examining a bank, to know what will be examined by the regulators. So let me talk about the first thing they're going to look at is the L of CAMELS. And the L is liquidity overview. And that is the ability to generate funds at a reasonable cost to fund growth in loans and runoff of deposits, and any other reason for concern about liquidity. Now, any bank can go online and acquire internet-based deposits as the bank is willing to pay for that. But problems associated for this type of funding can be mitigated, but regulators are concerned with a community bank that utilizes substantial quantities of these deposits because they're extremely volatile and expensive. It's what I call hot money. And you may recall that I talked to you earlier in the course when I worked at the Resolution Trust Corporation about these banks that were getting, such as the bank in Red Hill, Pennsylvania, that attracted broker deposits to fund its assets. So this training is for a fictional bank called First State Bank. It doesn't exist. It's just 10 years old, has assets about 200 million. And its last CAMELS rating, it was a composite rating of 2. But immediately after the prior examination, the management started receiving pressure to improve earnings that weren't bad, but somebody said, let's try to grow earnings. And so their idea was to grow loans. And what really became the problem for the bank is that they had high levels of commercial real estate and construction loans. And there were credit administration underwriting weaknesses. They were making a lot of loans without really paying attention to how creditworthy the borrower was. And that was the real concern. But we're first looking at liquidity, which was the funding of those loans. So there are 5 areas that the regulators review with CAMELS, and the first is known as the net non-core funding dependence ratio, and this is the degree in which the banks are funding longer-term assets, loans, securities that mature in more than 1 year, et cetera, with non-core funding, which includes funding that is very sensitive to changes in interest rates, such as brokered deposits, and CDs larger than $100,000 and borrowed money. Now, the second thing is that will mitigate this. Do they have a lot of liquid assets that can be convertible to cash without undue loss, such as Fed funds sold, securities that are available for sale? Then are their core deposits capable of funding their anticipated asset growth? And do they have a diversity of funding sources? So they have a core deposit base, established borrowing lines, and procedures in place for acquiring internet-based or other forms of emergency borrowing and using that only in emergencies. And then the other thing we always have to think about, remember conditions, one of the 5 C's of credit, the economic conditions, competition, what's going on, or someone trying to steal your deposits, marketing efforts, how are you getting deposits? All of these can have a material impact on liquidity going forward. So you can read this slide, pause the video to read this slide. So the net non-core funding dependence ratio is looking at their funding, and we will turn at this point to the PDF, which I'm going to show you, that has their ratio. So let me open the PDF and do a new share. So I'm going to stop sharing what I was and bring up the new share of the PDF and show you this. And here you can see some items that were circled here, which shows the non-core funding dependence, and that's in line, the first highlighted in yellow, and you can see as they're growing from 2002 to 2004, that ratio has increased, their funding that is not on their core deposits. And if you look by comparison to their peers, you will also see that their peers in general do not have as much non-core funding as they do. And you can see that down below. So now we will look at the answers to these questions for this bank. And so let me return to the PowerPoint. So looking at comparison to peers and trends, this is a bit of a concern. The trend is a rising dependence on non-core funding, almost 22% compared to the peer, which is at 15%. And that's meaning that a significant quantity of long-term assets are funded with non-core liabilities. So it's a red flag that the director should be having some questions for management. Now, it depends on the type of lending they're doing. For instance, agricultural banks are going to have very little cash flow until the autumn. And a construction funding may need different liquidity and payoffs from that type of bank. So what if they have a large loan maturing soon that will allow them to pay off their funding? What if they have borrowing lines collateralized by their loan portfolio, or a borrowing line from the Federal Home Loan Bank that will allow them to get funding pretty easily? Now, what was the report? The report was that these were satisfactory, but the decision is weakening because competition has caused deterioration in core deposit levels, requiring the funding of their loan growth with increased borrowings. So that would typically signify a 2. What were the negatives? Dependence on non-core funding, competition in the local market, and losing some deposits. But the positives were they do have some liquid assets that they could sell, and they do have some borrowing lines established. And the main positive, this management says, we're not going to continue this future loan growth that we've been doing recently. So these are the ratings of CAMELS that you would get for liquidity. And as I said, the bank got a liquidity ratio of 2. So just wanted to give you this little background about what we mean by liquidity. So we will talk about liquidity and liabilities in class. Thank you very much.